concert. That's a staple singer talking about, I'll take you there. I'm taking you there today. We're gonna go for the freedom portfolio. So we've been talking a lot about this, and I've been talking about it like without it being the main thing, just saying, hey, this is a freedom portfolio. This is what it looks like. These are the stocks in it. But there's way more to it than that. You got to understand why this is something that you want and why this is going to work for you. So welcome to the Freedom Portfolio Debrief. In today's session, I'm going to cover the entire strategy for building as close to a watertight portfolio as I believe is possible in the markets. There's a lot of things different about this. So get a pen and paper and we'll go through it together. And this is really focused on growth, and it's not really focused on market direction and stocks like that. So I'm going to show you how to turbocharge this portfolio structure to get some pretty incredible growth over time. A few weeks ago, during a members only class, I got a flood of questions about this particular topic, and everyone wanted to know how I use my triangle. I'll talk about more on that in a minute, to build a cash flow producing portfolio that wasn't dependent on market direction. That's the part of the freedom of it. Initially, I talked to the team about adding this freedom portfolio class as a brand new product because we were just overwhelmed with people that were asking for it. But instead of making it up as a class, a product to charge you, we decided to teach it for free, the entire structure of the portfolio and all the steps to build it. And that's what we're going to do today. So I know you guys are going to love this. This is what I do personally. One person asked how much your portfolio, your total portfolio, do you allocate to this? And I have about 85% in this freedom portfolio of all my trading, right? The other 20% is used for different types of trades with different amounts of risk and speculation to them. But this is the fundamental basis for everything. So grab a pen and paper, because this is going to be very educational, very practical, and very specific. Now, I can also tell you that a 12-year-old can do it. And I'll tell you about little Jack and then what his game plan is here also. But first, let's start with the big problem. And what it is in traditional investing, everybody looks at the value of their portfolio. When you log on to your brokerage account through your smartphone or laptop or whatever, the first thing you want to see is, am I up or am I down? And then that has emotion that comes right out with it. And in a market like this, that constant checking on your valuation can make you sick. But what if there was a way to avoid all that emotion and benefit from the stock market in a way to give you total freedom? And when I say total freedom, I mean total freedom. There's nothing to worry about. Freedom from ever having to worry about your portfolio. That's just part of the beauty of it. And I don't mean that theoretically. I mean seriously, not even caring how much it fluctuates day to day or month to month. Folks, that's true freedom, right? Now, for example, how would you feel if you knew you were going to get money from your portfolio every month, no matter what happened? No matter if the stock market crashes 50% or more, no matter what happens in the economy, with a recession, a depression, war, peace, whatever, you got total freedom. And you know that every month money is going to come into you, cash flow, not having to check on it all the time, never wondering what to do, never feeling the sadness, is what I hear from people, and the self-loathing people have that comes from making bad decisions and watching your net worth shrink. People say, like, why did I ever get into that stock? Why do I just keep losing money? Okay, this is different from that. This is what the freedom portfolio is all about, giving you the benefit of owning stocks without any worry. And that's really the meat and potatoes of the stock market when you're investing in companies, right? Now, this is not based on the portfolio's valuation, short, medium, or even long term. This portfolio is only based on one thing only, right? And this is it. How much cash flow does it produce every month? That's the whole thing right there. That's the whole focus. That's the whole reason why, we have it. This is the purpose of it, is to produce cash flow, versus a portfolio that's just going up and down and driving you crazy. That doesn't have a purpose. Okay. That has no purpose. That could even be considered a complete waste of time. Whereas the purpose of this portfolio, it has a purpose, first of all, and that purpose is to produce cash flow every month, because cash flow is king, folks. Even more so now than ever. I've been saying cash flow is king for years, but right now people see it, right? You're seeing it. It's the single most important thing, because you can live in a portfolio, but you can live off of cash flow. And a lot of people are saying, they're afraid that they're going to outlive their money, right? That's because they're talking about living off of the ups and downs in the valuation and selling some stock to bring in some cash flow. That isn't how you do it. Cash flow, you can live off of that. Now, to build a freedom portfolio that produces cash flow, you need a few things. So this is where you need to get your pen and paper. We're going to have a pop quiz after this. We're going to have a pop quiz. Okay, first thing you need is stocks, right? Sounds simple, but not just any stocks. You need a group of stocks that have special criteria with them. You can't just go randomly piling stocks into this portfolio. They have to be very specific stocks. And the first check that the stock has to have, as far as criteria goes, it has to pay a dividend. Now, we're not chasing yield here, right? We're not looking for the highest yielding stocks. As a matter of fact, statistically, there's proof that the highest yielding dividend stocks don't perform as well as stocks that have a yield in that medium range or lower range even. So we want a dividend, but we're not chasing high yield. Second thing it has to trade on a major exchange. No penny stocks, no funky business, nothing like that. Now, this third check is so critical. It's unbelievable. It has to have not just a dividend that it pays, but it has to have a history of a growing dividend. Now, the reason that is I'll get into that too, but we got to just remember that the growing of the dividend, the company that's sharing more profit with the shareholders as that company's profits increase, it has to have that history of growing dividends, and it has to have options. Basically, those four things we're looking at right there. You can write that down. Pays a dividend, trades on a major exchange, has a history of growing dividends. That's critical. And it has options. Now, if you've been with me for any length of time, you've probably heard me talk about these pillars before, because I believe in them. And they're the baseline of virtually everything I do. Like I say, 80% or more of my entire money in the market is in this portfolio. And today I'm going to give you a much deeper dive into exactly how this blueprint works. So I'm going to walk you through the details of how to build a freedom portfolio. Then we can go over some questions in the chat. So let's start with dividends. This is a big, big, big thing. I'll just tell you right now that a company that doesn't pay a dividend, it's because the board and the CEO especially would rather take that money in salary than share it with shareholders. That's just a simple fact, folks. So a dividend, this means a company is profitable. This is one of the best signs you can see, is that it pays a dividend. You can't pay a dividend if you're not profitable.
Hey everyone, Jack's signing off and signing back on, so he'll be on in just a minute. Hey Jack, welcome back. Hey Jack, you're muted.
All right. This part is critical because a company that raises its dividend to shareholders is a sign of a healthy business that's being well run, right? There's an easy way to get a head start on finding these stocks that fit this profile. I know a ton of questions will come in, like, how do I find these stocks? What's the secret to that? Well, it's pretty simple. These stocks that I'm talking about are pretty much referred to as dividend aristocrats and dividend kings. And there might be some companies that we have in this portfolio that aren't dividend aristocrats or dividend kings, but this is the easiest way to go start building it. Now, dividend aristocrats are companies that have raised their dividend every year for 25 years. How about that? That's awesome. Dividend kings have raised their dividend every year for 50 years. Now, one of the things about this raising dividends is, inflation is in the news all over the place. So when you got a company that raises its dividend, if they raise the dividend 9%, they're keeping up with inflation. You got nothing to worry about. So that's why we only want to focus on companies that have a proven track record of being able to do this. Now, look at this. This is dividend aristocrats versus the S&P 500. The aristocrats is in light blue, the S&P is in dark blue. And there's just a ton of research out there about how dividend stocks outperform the S&P in general over any given time period, which is why we want to have the bulk of our money in this portfolio. These are the best stocks you could be holding. No question about it. Now, we can compound the return by reinvesting the dividend back into buying stock, and that produces enormous returns, and it easily beats the market. So dividend payments reinvested back into buying more stock, which means the stock pays for itself. How about that? Now, this dividend compounding effect is responsible for 84% of the total return of the S&P 500 from 1960 to 1921. 84% is from compounding, right? You got to be doing this. Now, from the time period between 1930 and 2021, dividend income contributed an average of 40% to the total return of the S&P 500. And this goes to show how important dividend stocks are and the growth of the economy and how it's going to continue to do that. Now, here is where it's reinvested. Look at this. This just blows away, right? The S&P index price only, no dividends is in light blue, and the dark blue is reinvesting the dividends, right? This is where the money's being made right here. So talking about compounding, Warren Buffett says, my life has been a product of compound interest. His old buddy, Charlie Munger, says the first rule of compounding is never interrupted unnecessarily, right? It's just all the richest guys in the world use compounding, right? And the stock market is like the best place to do it, right? So if the smartest and wealthiest people on earth are telling us how important this is, I think we should listen. But here's what is important to understand is starting with a curated portfolio of the best dividend stocks is the first step to have an automatic compounding setup working on your behalf. So of course, we're going to start our Freedom portfolio with a group of dialed in dividend stocks, but that's just step one, okay? We want to turbocharge this compounding effect with a twist. Now let's take a second and break this down so you understand exactly what we're trying to accomplish with this compounding portfolio. Let's use an average 401 account balance in the US of $129,157 to walk you through this example. 129,157, right? Growing at an average broad market 6% per year would grow to about 420,000 over 20 years. And that's just at an annual rate of 6%. Now, really, that's not too bad. And frankly, we're blessed to live in a time where public markets exist like this, and they're quite positive over time. Sitting back and letting your account grow with the broad market is a great idea. But most people I talk to can't afford to wait for 6% per year to build their account for 30 or 40 or 50 years. That's probably a lot of you guys too. I know I don't have another 50 years. And the fact of the matter is there's way better opportunities out there. Let's add dividends into the mix here. The top dividend stocks are paying between, I'd say, right around 4 to 8%. Some of them a little bit less, some of them around 1.9%. But this doubles the return all by itself. So if you take the 6% compounding and turn it into 12% per year, that same account of 129,000 goes to 1,260,000 over the same 20 years. It's just a skyrocketing annual rate when you're compounding this. This could be 3 times the return just by adding dividends. Isn't that amazing that doubling the return of 6% to 12% more than triples the effect of your money? That's the crazy part. That's the power of compounding. But as I said, we want to take this powerful portfolio strategy and turbocharge it. And we do that by adding covered calls into the portfolio. So the stocks we have in our portfolio, they're paying a dividend, and we're selling covered calls at a higher strike price on these stocks. And that premium hits our account immediately. Now I'm going to go into the details of how we use covered calls for those that don't know in just a second. But for now, it's important to understand that covered calls pay us an extra premium on the stocks we already own. And you can set this up to where it's paying you more every month selling the covered calls. And I would target about 1.5% every month on the covered calls we sell against the portfolio. This could be a lot higher depending upon how volatile the stock is. Now, all these stocks, they don't have the same price to their options, right? Some of them that are a little less volatile will have a lower rate, but that's an outstanding 18% per year bonus return on the stocks we already own, which jumps that 12% return all the way up to a staggering 30% per year, folks. So let's take another look at our 20-year chart on the average 401k. The same $129,157 account growing at an average, right? Could growing at an average of 30% per year would grow to nearly 25 million in the same 20-year span. And we're going to take these same techniques and apply them right now. Now, I know those numbers sound crazy to most people, and that's because they are crazy. Growing an account from 129,000 to $25 million would be an incredible feat for anybody. But that's exactly why Albert Einstein said the most powerful force in the universe is compound interest, right? Now, I can't exaggerate the power of compound interest enough. I have to almost blush when I share these massive numbers because they sound so unreasonable to most people, right? This is just math. These amounts on this chart aren't my crazy predictions. It's just math. 129,000 at an annual rate of 30%. It goes off the charts to $25 million. Now, can you see why I'm obsessed with this? I'm just totally obsessed with this because it works, and it works for everybody I introduce it to. And that's what makes my Freedom portfolio so powerful. So not only does it produce constant cash flow in the form of dividends and premium, no matter what the market is doing, but it turbocharges the most powerful force in the world, compounding interest. And here's the best part, folks. It's a perfectly scalable, and each element ties into the next. So this is what it looks like. This is the wealth triangle applied to investing. This is something that I personally do. I love doing this because I love the results. You see the results happen. And this is the most passive form of income in the world. Passive income where corporate America is paying you in the form of dividends, and you're paying yourself using Wall Street to sell covered calls. So you're using corporate America's paying you, and you're using Wall Street to make even more money. That's a beautiful match. So it all starts right here with number one. You buy a stock and you start receiving the dividends. Step two is we're going to increase the income using covered call options to get even more money, an additional 12 to 24% a year. That's not too hard to do. And then what we're going to do is we're going to take that dividend and that annual increase and buy more stock. That's where the compounding comes in. Now, you don't have to do that. You could just use the dividends and the additional income from the options as cash flow if you want to take that and spend it and live off of it. You can do that too. But are you seeing how seamlessly builds a monster cash flow portfolio, and it sets you up to turbocharge the compounding effect at the same time? So let's go through the exact steps to make it happen. First, we're going to buy 100 shares of a king, right? One of those dividend kings. That's a very first step. Now, you don't have to buy 100 shares, but if you don't buy 100 shares, then you can't sell a covered call, right? And that's a key part of this strategy. So you want to find a king that you could buy 100 shares of. And my number one recommended king right now is ABBV. This is a well-run company, to say the least. It's perfectly managed. They got a massive balance sheet, sitting on a ton of cash, pays a great dividend. And it's been doing it for 50 years. So the odds of it stopping now are pretty low. You know, these guys, none of them want to spend 50 years getting to the status of a dividend king and all of a sudden screw something up and they don't do it. So that doesn't happen. The other thing is a stock like ABBV, this thing could drop down 50%. The stock market could crash. The stock market could drop 80%. This stock could go down 80% with it, but you know what? They're not going to stop paying the dividend. They're going to pay the dividend no matter what. That's part of their business operations. It has nothing to do with the stock price. The stock price has nothing to do with their ability to pay the dividend. Same thing with all the other kings. Coca-Cola could go down. It could go down. It could get cut in half. They're still going to pay the dividend, folks. This is why you've got the freedom. It doesn't matter what the price of the stock is. The only thing that matters is how much cash flow can you generate. So step one, you buy the stock. Step two, you start receiving the dividend. You don't have to do anything. This is why they say it's the world's best form of passive income, living off of corporate America's dividends, right? That's the dream. Step three, you reinvest the dividend. And all you got to do for that is just check the box on your brokerage platform where it says reinvest the dividend, yes or no. Yes, you want to reinvest the dividend. Just check that box on your brokerage firm. Now, step four, this is where the turbo starts coming in, right? We're going to sell a covered call against that stock to bring in even more cash flow. So the questions always are with options is, number one, what stock, right? So we're going to solve that problem with the stock. The second thing is, which strike price, right? So you want to pick a strike price that's 7 to 10% above your purchase price. And then the next thing is expiration. You always want to know, what expiration do I choose? Well, 30 to 40 days away out in time is really good. That's going to allow you to do this 10 to 12 times a year, right? Which is really going to boost your yield significantly. And then step 5, you buy more stock. Now, you can use the income from the covered call to buy more stock to keep the triangle rolling. Ideally, you never want to have the portfolio stop. You never want to have the triangle not running. You always want to have the thing running all the time. You never want it to stop, right? You don't want to forget to sell that covered call. It's only once a month. There's not a lot of trading in this thing, right? So you got to use that to buy the covered call, to sell the covered call, I'm sorry, to buy more stock and keep that running. Now, does this make sense to everybody? Type in yes in the chat if you're with me so far. Yeah, you want to print out, Fong, I'll get you a copy of it. Yeah, you guys are with me. This is cool. So I tell you where to find those stocks. Yeah. Yeah, right on. Okay, good. Let's keep rocking and rolling. All right, here's the summary of the steps. Get your pen and paper up. Pop quiz on this. We're going to buy a king. We're going to collect the dividend from the king. We're going to reinvest the dividend. And then we're going to sell covered calls against your stock to buy more stock, right? That way, that thing is just rolling. Now, this is exactly what I do. At some point in my life, I'll be taking the dividends and I'll be taking those in cash, and I'll be selling the covered calls, and I'll be taking that in cash, but not now. I'm going to let this thing run until I don't want to work anymore. And at that point, I'll stop the triangle and I'll just receive the cash flow myself. And you can do that right now if you don't want to build your portfolio. You just want to take the pure cash flow. And the power of investing this way, it can't be overstated. It is the ultimate freedom portfolio because I don't have to worry about what most people struggle with when it comes to investing. You're never going to hear me cry and moan and complain about the portfolio going down, because from a cash standpoint, it only goes up every month. It goes up. Now, I have the freedom of not worrying about the shorter medium-term direction of the market in my freedom portfolio. I know it's generating premium cash flow every single month. And on top of that, compounding over the long haul. You know, companies like ABBV, every day they got cash flow coming in. Same with Coca-Cola. It's non-stop global business. You know, it just keeps on coming in, keeps on coming in, and it's all passive income. And this portfolio also gives me time freedom because I got the thing set up and I just let it do its thing, right? I don't have to spend a ton of time researching companies or watching them or putting in stops or all that kind of stuff. Now, those steps are only a few minutes a month of work all combined. Really, it takes almost no time at all, and it's fun to do. I love seeing that cash hit my account from a covered call. And this all means I'm not staring at my charts or managing positions. I spend my time teaching, researching other opportunities, spending time with my grandkids, which is my favorite thing in the world, and fly fishing, right? While the freedom portfolio produces on its own. And I'll tell you something, grandkids can do this, right? You can even teach this to your grandkids. My little Jack, he's going to be one of the greatest investors of all time. So when he looks at a stock, he doesn't look at a stock and I show him the chart of the stock. That's always important. You want a decent trend, right? You don't want to buy a dying business like 3M, but he'll look at this chart and he's just now seeing where the yield and the dividend shows up. But what he used to do, I would show him a chart on a stock, and the very first thing he would say to me is, Papa, how much does that one pay you to own it? That was like the best question I've ever heard in my life, because he's looking at it as an investor, right? And he says, how much does that one? He's talking about a specific stock. We look at all these different stocks, and he's not concerned about how much the value of the stock price is going to go up. He knows that you make a profit like that. But his whole thing is, how much does that one pay you to own it? That one stock versus that other stock. I love that. I love that. That's like, he's got the start right there of being one of the best investors ever. And he's got a lot of time to do this, but you can teach it to your kids. You got an 8-year-old granddaughter. She's just now coming on with this. And I got a 3-year-old grandson, Oaks, who's clueless, but I'm going to bring him up to speed when the time is right. Now, if you want to mirror my personal freedom portfolio, including all the exact stocks and the specific covered call positions I recommend every month, then join my Wealth Triangle report. This is what I do. This is how I help people. And we're having a little fun with this because there's one particular stock that you can follow with me every month and do it, and it's Apple, right? So it's very cool because every time we sell a covered call on Apple, it lowers our cost basis on the stock. And Apple's not the biggest dividend paying stock in the world. They pay a little piddly ass dividend. I don't even think it's 1%, but they're on track to grow that dividend probably more than any company out there. They're sitting on, I was looking at the cash yesterday, and the billions are sitting on. So I expect them to start raising their dividend as well. And that's the fun of it, is you can do it with me. Exact same stocks, exact same trades. I got them all listed in there. And it contains the real-time updates on the Freedom portfolio, along with a bunch of other material you're absolutely going to love. First of all, you'll get all my hand-picked stocks. Now, inside the members area of the Wealth Triangle report, there's 25 stocks listed in there that you can use to build your portfolio. And I've got an asterisk next to each one of the stocks that I own personally. So you can either build your own portfolio out of that 25, or you could build your portfolio out of the 13 or 14 that I have in there, or you could just pick one, right? Or you could pick 2 or 3. It doesn't have to be big. It just has to be where you've got this thing working, and then you fall in love with time. You and time become really good friends, right? Now, you're also going to get real-time alerts. Anytime I add a new stock into the portfolio, you'll know about it. Every week, every Monday, I'll give you a new trade to do. Now, you don't have to take the trade every Monday if you're not looking for another trade. It's just that we don't want to ever stop this triangle. So every Monday, I'm going to give you a new trade in case you're looking for a new trade. But once you got that trade on, it's going to last about a month until that option expires. Then you're going to sell another call. So these stocks, people ask me, what's your hold time? Indefinitely, right? I don't plan on selling these stocks ever. I plan on passing them down to my kids and let this thing keep working. So when you have that indefinite hold time on the stock, you also then don't have to worry. You're buying part of a successful business, and you're not going to sell it. That's what smart people do. Now, these stocks serve as the basis for the Freedom portfolio, and I regularly rotate them to get the best long-term performance. And my goal is to maximize the compounding effect of the portfolio by combining long-term growth with top dividend payouts. So when I add a stock, it's because I want another stock in there, right? I'm not going to sell one, but I'm going to add one to it from time to time. And the alerts include the exact ticker, right? This alert gives you everything. It gives you the exact underlying stock, right? We're using calls. We're not using puts. I give you the strike price you should ask for, the expiration date, and the amount of premium on that call that you should ask for. So there's no thinking on your part, right? I'm going to do all the hard work for you and spoon feed you the best of the best. You're also going to get the covered call that I'm trading across the entire portfolio to turbocharge the portfolio. You can even go in there and follow me on that Apple trade. We started doing this all together when we started this Freedom portfolio and this Wealth Triangle. People want to know, Jack, what are you doing with your own money? I mean, your real money. I mean, your serious money. Well, this is what it is. Okay. So when we started doing it with Apple. And so everybody could get on board, and then we're just rocking and rolling. You can follow that entire update. There's over 1 year's worth of my covered call trades on Apple in there. That means you'll have every detail of the positions to enter that generate that beautiful premium that I love. And then every Monday, I'll be sending them to you again. Now, remember, we're targeting about 1.5% per month on top of our baseline performance. And that really adds up. And that puts us in a position to target a stronger, faster, more aggressive compounding interest rate curve. Just like we talked about today, that rate just starts to skyrocket. And of course, like everything we release, you're also going to get unlimited support from our team here. This is the best team I've ever had. And all of this is inside the Wealth Triangle Report Service, which is what I want you to buy today. And I want you to allocate some of your capital to this, even if it's a small amount, because this is what works, folks. This is what the elite do. This is what the top 1% of the 1% do. And I'm bringing this technique and this style and this portfolio all the way down to the little guy. So you could even start it with one stock, right? That's how confident I am. This will work for everybody, no matter how much you're starting with. Now, let me be honest with you. This is the foundation of what I do. And members of the Wealth Triangle Alert are getting my personal blueprint and real-time actions on the best way to build wealth I've ever come across. Now, you saw the power of compounding interest when you can turbocharge the returns of your portfolio. So I don't think I need to convince you of the value of this. It's going to work for you. It's passive. You don't have to put any effort into this outside of once you've built that portfolio, and then once a month, you're going to sell a covered call on all those stocks. But even though I think this has the potential to be the most valuable service you ever get your hands on, I think it should be the starting point for every investor. In other words, I don't want the Wealth Triangle Report to be an elite service that costs thousands of dollars. That would defeat the whole purpose of it. Instead, I want every one of my readers to be able to put this into action today. Today is a great day to start doing this. The stock market is open. You can go into the members area and see the stocks that I like. You could start with ABBV, right? And that way you can put this into action and you can start to see the wealth creation happening in your own account. It's very exciting. So instead of charging my publishers $2,500 a year recommended price, I'm going to make it available for a fraction of the price. Now, before I tell you just how good of a deal I'm going to give you, I'll admit that I have a bit of an ulterior motive here. So you might be thinking, okay, Jack, I know you said you want it to be a starting point, but isn't it updating this portfolio still a lot of work? And the answer is yes, right? I keep my eyeballs on the research part of it because I believe in the Freedom Portfolio approach so much that once you get your hands on it, you'll see the value of this method. You'll stick with me for a lifetime. And that's what I want. I want you to stick with me for a lifetime, and you'll want to take advantage of everything else I do too, right? This is the basis of what I do. So we know I'm probably not getting nearly as much value out of the work I put into the Wealth Triangle Report as I could. I think it'll be a win-win situation for both of us in the long run. So all this, it's not going to be $2,500 today. In fact, it's just a small fraction of that for new Wealth Triangle Report members. This is a very special deal. And there's even something else in here that's going to really blow you away. You get the Freedom Portfolio, you get the covered call signals, you got the hand-picked stocks, world-class support, you get the trade alerts, and you get the Wealth Triangle Report where you'll learn how to do it. But there's also something else inside this members area. And what it is it was 12-week training on strategic trading. And at one point, I sold just that course for $2,885, and you're going to get it free inside this. So today, the whole price of this, you can join in the link above. Go to jackcartertrading.com/WTR or give us a call at 904-416-1776. It's just $595 today. That's it. Now, remember, you're going to get the Freedom Portfolio covered call signals, the hand-picked stocks, the world-class support, the trade alerts, the Wealth Triangle Report, which teaches you how to do it. And you're also going to get the strategic trading class free, right? So this is just such a great deal. $595 for everybody today. And that'll give you a 1-year access to the Wealth Triangle Report, including every update and every covered call monthly alert. Just go to jackcartertrading.com/WTR or give us a call at 904-416-1776. And we'll have you up and running. So that's up to 200 premium producing alerts for just $595 today, right? So go to jackcartertrading.com/WTR or give us a call at 904-416-1776, and we'll have you all set up. Now, let me go into the chat. Yeah, there's the link, jackcartertrading.com/WTR, or give us a call at 904-416-1776. We got our educational directors. We'll answer that number. These are not just customer service people in some other country. They're all here in the United States. They all know what's going on. They're all familiar with this stuff, right? They can help you get set up. They know everything about it. When you call that number, you're going to talk to Jeffrey, Mike, Kelly, or Melissa. Those 4 people, they'll have you covered, no problem. So go ahead and give us a call at 904-416-1776. Yeah, Chuck, I got a lot of stocks in there, inside there. We should have the replay up. Yeah, so Madeline asked a good question. How much do you have to have in your account to buy 100 shares? Well, it depends on the price of the stock. ABBV is at 140, so that'd be $14,000 to purchase 100 shares, or just $7,000 if you did all this on margin. Yeah, Little Jack is 12, Oaks is 3, and Nora is 8. What happens if the call goes sideways, Dr. John asks. I'm not sure what you mean by that, but we haven't really had them go sideways. At the end of the month, you're either going to have the stock called away from you or not. And we have all the profit. Everything is shown to you. We have the covered call calculator is even in the members area here. We didn't have that listed on this page. Now, Billy Wags asks, do you go 7 to 10% from your cost on the stock or the current price? It's better if you do it on the current price, right? But you'd have to look at your cost basis. The idea is to lower our cost basis every month by selling covered calls. Like with the Apple, I did it so many times. I had my cost basis down to like $108. And then I did get called out at like $155. So that's like one of the big, when you get called out, that's like one of the biggest profits you're going to make, right? But if a lot of times people don't want to get called out, so you're going to pick a strike price that is 7 to 10% higher or lower, somewhere in there with that 30 to 40 days out, and you'll be all set. And you'll see me do it. Yeah, we're going to sell monthly, not weeklies. All right, Fong. Minimum capital suggested to do this. I don't know. I would get started with at least one stock. If the stock goes down, it's okay. G says, what if the stock goes down? It doesn't matter. That's the whole freedom portfolio. If it goes down, it doesn't matter. With these stocks, when we just looked at how they perform, they outperform the market. So these are really not stocks you got to worry about, like some tech stock getting cut in half. Nothing like that. These are just stable. This is corporate America we're buying right here. So it could go down. Stocks go up and down all the time. Apple, when I owned it for the last year, look, it's gone all over the place. It's gone down, but overall it's going up. And when you're selling that covered call, you're really lowering your cost basis every month. Typo 1 alerts. Yep, Brad. So Mary Alice, the rules are, we're going to look for once we got our stock, we're going to look for a strike price 7 to 10% above that with a time frame of 30 to 40 days out. Similar to what we're doing with Goog. Yeah. Now we're not buying any covered calls. We're selling a covered call. What that means is we got 100 shares of stock, and when we sell a covered call, we get money immediately. We sell the call and we take on the obligation of delivering that stock at the price at the expiration date, right? The buyer of the call, he's bought the right to call the stock away from the market at that strike price until the expiration, and he pays for those rights. The call seller receives cash immediately for taking on the obligation of having to deliver that stock at the strike price. That's why we need to own the stock first, okay? Yeah, Dan says it seems if you get the stock called away from you, you'll need to buy it back at a higher price. Not necessarily, but it doesn't matter. We got to get off of this price issue, because that's the valuation thing that we're getting freedom from. So if I get called out, I got called out on Apple once time at like 1:35, and I bought it the following Monday. So if you get called out, it's going to be on a Friday. And then the following Monday, we just go in, and buy the stock again and sell another call that same day. So you might be buying at a higher price, but again, you got to get that price stuff out of your head and cash flow into your head. So when we're dealing with these stocks, people are like, "Oh, Jack, you got called out at 135. Oh, now it's like 141. Big deal. I buy at 141. Look at where it is today." This is what I'm talking about is too many people. And it's almost like they just can't get it out of their head dealing with price. Whereas you got to just get it into your head that we're dealing with cash flow. That's the only thing that matters. So Apple's going to go up and down a little bit. ABBV, same thing. But it doesn't matter because all we're looking at is the cash flow. But it's good. It's just more cash flow. So Chuck says, how do you handle or adjust if a stock takes a sudden drop 20 or 30%? I've never seen that. I've never seen it. I wouldn't do anything. Coca-Cola dropped 30%. I wouldn't do a thing. I'd probably buy more of it, because the stock price, it doesn't have anything to do with their financials. It doesn't. It's two different things. The stock price going up and down, it has no effect on Coca-Cola's ability or ABB's ability to pay the dividend. Yeah, this Bruce G brings up an excellent point. I love this. Bruce G, you're a little ahead of me. So he says, if you have 2 or 3 stocks in your portfolio, will you use the dividends of one stock to buy shares in a different stock? The goal would be to get your stock shares up to 100. Yeah, you can do that. So what you would do is you would buy your dividend stocks and you would not check reinvest dividend. And what would happen is the dividend would just get paid to you in cash. This is how it happens anyway. The dividend gets paid to you in cash. The broker sees that you're reinvesting the dividends, so they do that for you. There's no charge for that. The other thing that's so super cool about this, that this is just kind of a recent development, is that if your dividend isn't big enough to buy one share of stock, the brokerage firm will buy you a fractional share. Right? That is the coolest thing ever. That didn't used to be the case, but that's how it is with Schwab. When I started, if I started with a new stock, maybe the dividend from that quarter wasn't enough to even buy one share. So whatever amount it was, if it was half a share or a tenth of a share or whatever, they still did it for you. So if you don't want to reinvest into those same stocks, you would still take the dividend in cash, but you wouldn't check the box to reinvest the dividend. And then you would just do it yourself. You would just buy whatever amount of stock you could buy with that dividend on a different stock, right? He's saying. So that way, you could take the dividend from one stock and the premium on the covered calls from one stock and use that cash flow to buy another stock. That's a really good way to do it. Now, Roland K, which is the cheapest stock in portfolio, I don't know, but I wouldn't look for the cheapest and I wouldn't look for the highest yield. Ford would work. Herc is asking about Ford. Ford would work. Ford is not in my portfolio, but Ford would definitely work. The only problem with Ford is the options are really small, right? The covered call, the premium you're going to get is tiny on Ford. That's the only thing. Now, Anthony says, sell a put and get stock at a discount. Yeah, that's true, Anthony. You could do that. But here's the thing. If you sell a naked put trying to get the stock, you're missing out on the cash flow. You're not getting a dividend and you can't sell a covered call. You're tied up until you get the stock put to you or not. Now, you could sell a naked put after you get into this thing, but you won't have the triangle rolling if you're just waiting and waiting and waiting to have the stock put to you at a discount. I do a lot of naked puts, but not with this, right? With this is, again, when you say sell a naked put so you get the stock at a discount, the discount means you're still thinking about the price of the stock. We got to get that price stuff out of your head and focus on the cash flow. So don't worry about it getting at a discount, right? Just keep the whole price thing out of it. And that way you'll be thinking better, more accurately. Well, Dr. John says, can you estimate out of all the stocks you own, how much 100 shares would cost? Right, 100 shares of Coke would be less than $7,000, be 3,500 if you did it on margin. But I don't know because I got all kind of different price stocks in there. AVGO is one I own. That's 500 and some bucks, right? So I like all the premium. Jeff Yo, you're killing me. Don't ever use margin. Margin's is a great thing. Yeah, so that's what I want you to do. I want you to start thinking about just the cash flow. How much cash flow does this portfolio throw off every month? Now, I'll tell you something. You'd be really surprised that 2 or 3 months go by and you're going to see this thing grow, right? That's how the wealth creation starts. And then when you see that and you get some bigger positions, you're going to start bringing in even some more. Yeah, margin is fine. You could buy on margin. Yeah, you could buy. There's no problem with a margin, Mary Alice. You can't do that in an IRA, right? Now, you wouldn't buy more stock for the call, Madeline. Like if you get called out, you get called out. You wouldn't want to buy another 100 to cover the covered call, right? If you get called out, you get called out. You have no obligation. If you sell a covered call, you have no obligation to buy more stock for that call. Your only obligation is to deliver stock at that strike price, and you're covered, because you already own 100 shares of the stock. So if you buy 100 shares of AbbVie and you sell a call, right, that's going to lower your cost on AbbVie by the amount of premium you received, right? And if you get called out in 30 to 40 days, then you do. And if you do, then you get called out, you're going to make a bigger profit, right? You're going to make the difference between the price you own the stock at and the strike price, which is always above your cost on your stock or your purchase price. So if you get called out, you're going to make more money. Now, you could use the weeklies, Jerry, but you're going to do 4 times as many trades. And that might not work out to your best advantage, right? Some of the real sweet spot is right into that 30 to 40 day time frame. If it was weeklies, I'd be using weeklies, but I use weeklies for other things. I don't use weeklies for this. I don't want to be doing that much trading. One trade a month on a covered call is perfect, right? So I don't want to go too crazy with this. I don't want to be too active with this. I don't want to have to spend a lot of time in the market. The whole freedom part is that you're not doing it once a week. That's like 52 weeks of trading. So Pamela, if you got AbbVie at a higher price, you would, and it's at 140, you would want to pick a strike where you wouldn't be getting called out at, right? That way, if you own AbbVie at an even higher price, if you get called, if you own it at 175 and you get called out at 150, then you're losing 25 minus the premium. So you'd want to create a strike price that would be at a price you wouldn't get called out, even if that means it's higher than that 7 to 10%. One a month, Chuck. We're gonna do one a month. So I'm gonna show you when you join. You can go in and look right at my Apple trades, all of them. You can see exactly what's happening, and then I'll have a new one for you every Monday. So that's 4 trade alerts per month. You don't have to take all of those, right? That's not the purpose. The purpose is to give you a possible trade if you need one. If you've got an option that expired on one and you need another trade, or you got more money to put into your portfolio, you're going to get an idea every month. No. So Mike asks a good question. He says, if you get into covered calls with expirations 30 to 40 days out, but the stock hits the strike price, let's say a week after you buy it, and there's still 30 to 40 days, would you get called out right then? And my answer is no. You could, but I've never seen it happen. I've never seen that happen because the buyer, right, he's going to want to see, hey, if this stock really goes up, right, and it goes over the strike price, then you're going to have it called away from you. But if the stock really spiked up right after you bought it and you still had 30 to 40 days out, you probably wouldn't get called out until expiration. It's just so weird how most options are not exercised. Most options are just, once they're bought, they're sold, right, before expiration. So I wouldn't worry about getting called out, but if you do, it's going to be pretty good. Okay, Chuck, I got to make a connection here for you on that. Now, every Monday, you're going to get a new trade idea, but every trade idea lasts 1 month. Okay. So on Monday, I'm going to give you a stock to buy, or maybe you already own it. And then I'm going to give you the exact option strike price and expiration and premium, how much premium you should get for that. So every Monday, I'm giving you that. But each trade lasts about 1 month, 30 to 40 days. So if you want to build on your portfolio, that's where you take a new Monday trade, but you don't have to take every Monday's trade, right? That's just to keep your triangle rolling because we never want to stop doing that. Okay, so we're not using puts, we're just using calls, and we're not buying calls, we're just selling calls, because when you sell a call, you get cash hit your account instantly, and that's guaranteed. When you sell a call, that money is guaranteed by the exchange to hit your account, which is kind of crazy. You would think that you would only get paid if the trade worked out, right? Yeah. I use Schwab. That's a good broker. And all the stocks are in there. You could put together a killer portfolio today just by going into the members area and looking at the stocks I have listed. You might already own some, right? You might already own some, but you don't own 100 shares, right? So now you know which ones, hey, this is a good one to buy now. Does that make sense, Chuck? What I said about every Monday's trade alert, but the trade lasts about a month. Now, Mark asks, how do you exit a covered call? Well, that's a good question. You can get out of a covered call anytime, because what happens is when you buy the stock, then your initial trade with the option is sell to open, right? So if you didn't want to own that option anymore, you might want to close it out early, or you might want to close it out, right after you get messed up in it. But you can get out of the covered call anytime by buy to close, the exact same option that you sold. Yeah, you'll love it. It's cool too. You can have a calendar set up where the calendar shows you what days your dividends are coming in, right? That's pretty sweet. So if you've seen mine before, it just says, ABB is paying you X amount today or Wednesday or whatever the day is. So ahead of time when all these dividends are coming in. It's pretty cool. It's pretty cool to see that happen. All right. That's what I got for you today. We had so many questions about the Freedom Portfolio. I just wanted to go over it A to Z, teach this to you because this is where the bulk of your money should be. And then if you want to join me and continue doing it, never let the thing stop, go to jackcartertrading.com/WTR and they'll get you set up with a username and password. Yep, they're all set. 904-416-1776. This is good stuff, man. This is where it's at. This is not get rich quick. So many guys are chasing these meme stocks and all this crap with BBBY and all this other junk. That's nonsense and it's noise. And this is where the rubber meets the road. Okay. This is where it's at. This is how the money's made. Kim, I'm glad you liked the presentation. Yeah. All right, guys. That's all I got for you. This is my most powerful thing that I do personally. Yep. And it's fun. You know, you put that covered call on, you see that cash hit your account. Now, like I say, if you don't want to reinvest it, you can take all that. I mean, you get this thing up, you're making you're making a lot of money every month, passive income, right? With the covered call and a dividend, you could take that all in cash. That's what I plan on doing down the road, but not just yet. Until I totally retire, I'm just going to let this thing build and work itself. Passive income, the ultimate form of passive income. Remember, we got corporate America paying you. They work for you. They're paying you dividends. And then you're using Wall Street. They work for you too. You're using Wall Street to sell the covered call, right? It doesn't get any better than that. To have corporate America working for you and have Wall Street working for you, where you're using Wall Street, you're using them. They're not using you. When you sell covered calls, you're doing the same thing they're doing. They're selling options. When you buy options, they're getting rich because most of the people that buy options lose 100% of their money, right? This is just something that's not going to go away. This is something that's always going to be there. If these companies have been paying dividends for 50 years every year, right? They're not going to stop, right? Those are great. That's the best part about corporate America you could buy, right? And I know you'll see results from this. I know you will. I just know you will. So if you're tired of losing and you're tired of getting worn out by looking at the value of your portfolio, build yourself a freedom portfolio, folks, and get away from all the hassle that this market gives people. People are talking about recession, depression, energy prices, inflation, all this stuff. And none of that matters when you got a freedom portfolio. You're free from all that stuff. You don't even have to read the paper or look at the stock market. Just that's the part I love about it. And it's so simple. A 12-year-old could do it. Okay. All right. I'm glad you guys joined me. Go to jackcartertrading.com/WTR or give us a call at 904-416-1776. Join me in the Wealth Triangle Report. You could see exactly what I'm doing. You could see all of my stocks are listed in there. There's probably 25 stocks listed in there, and I don't own all 25, but the ones I do own are all got a little asterisk next to them. All right, John, thank you. All right, guys, it's been great. I hope you enjoyed this presentation as much as I enjoyed doing it with you. This was a great class, and I hope you take advantage of this freedom portfolio because you deserve it. Give yourself a break, give yourself a little freedom, and give us a call at 904-416-1776 or go to jackcartertrading.com/WTR, right? You'll get this whole thing for 1 year. I know you're going to love it. It's a lot of fun. You can see me doing it. I've got an update on my trade there in Apple every month, right? So you can see that whole thing. And I know you're going to like this. And then you can continue to do whatever trading you want to do with other money. But really, the bulk of it should be in something like this because this is what is going to happen for you. This is where the money's going to be made passively. All right. So that's it. If you want some freedom, build your freedom portfolio, go to jackcartertrading.com/WTR or give us a call at 904-416-1776. This is Jack, and I'll see you next week on What's Up, Jack.